Welcome back to the Deep Dive. Today we have a fascinating challenge. We're going to try and translate, global geopolitics and these really complex international trade agreements directly into a single company's quarterly profit statement.
It's a great one.
We're diving into the Q2 FY26 performance of GOKEX Exports, one of India's major apparel manufacturers, and their numbers, well, they present a contradiction that is truly striking.
It really is the perfect modern case study. You look at their internal operational metrics, how they're performing in their home market, and they are absolutely thriving. They're showing real momentum.
Right.
But then you look at the final figure, the profitability, and it just drops off a cliff. It's a textbook example of a strong ship sailing into just massive external headwinds.
Absolutely.
Right.
So our mission today is to figure out why this financial whiplash happened. We have the company's investor presentation, some critical analyst outlooks, and a detailed technical breakdown of the stock chart.
And the big question we need to answer is structural, I think. How much of this profit volatility is manageable through clever internal execution? Better cost control, new factories, and how much is simply dictated by shifting U.S. tariff policies and the timeline for trade agreements happening thousands of miles away.
Let's start by unpacking that financial contradiction. Okay, so when we look at the Q2 FY26 headline numbers, you immediately see this split personality of the business. On the revenue side, the news is robust. Total income grew a respectable 7% year over year.
Cleared the 1,000 crore mark for the quarter. Not bad at all.
Not bad. But here's the critical detail. Their India operations showed phenomenal, robust growth of 14% year over year.
And that 14% growth in India is the key performance indicator of internal health. You have to remember, and this is crucial, this happened while overall Indian apparel exports actually degrew by 2% during that same period.
Wow, so they're outperforming the market significantly.
Massively. They aren't just surviving, they are aggressively gaining market share in a tightening domestic market. It just suggests superb management control over manufacturing and supply chains within India.
Okay, so if the top line and the core domestic business are firing on all cylinders, how on earth do we explain the bottom line disaster? Net profit after tax, Pat, was down a brutal 71% year over year. It fell from 28 crores to a meager 8 crores. That requires a huge amount of margin pressure.
It does. And we can immediately trace that pressure to, well, two external and two internal factors. Starting with the external pain, the first is a sort of geographical divergence. Their Africa operations saw a sharp decline of 23% year over year.
23%. Why?
Management explicitly linked this volume decline to uncertainty surrounding the renewal of the African Growth and Opportunity Act, or AG.
For those who might not be familiar with AGO, can you quickly explain what its function is?
Sure. Essentially, AGOA allows favorable, often zero tariffs for certain African goods coming into the U.S. market. So when the renewal of that act is uncertain, U.S. buyers, they pause. They delay placing large orders in places like Kenya or Ethiopia because they're waiting for policy clarity.
So geopolitics instantly hits their global volumes and their operating capacity in Africa.
Instantly.
Okay, that explains the volume hit in Africa. But what about the tariff cost hitting the overall global operation? That must be dominated by U.S. trade.
The company reported flat EBITDA at 84 crores, which is an 8.3% margin. That's a massive squeeze for a manufacturing operation.
And this is where we get to the core mechanism of the financial pain.
Right.
The company explicitly cited the impact of sharing a considerable portion of the U.S. reciprocal tariff burden with its key customers.
So how does that profit sharing work exactly? Does the manufacturer just voluntarily offer a discount, or is it demanded by the large buyers? Oh, it's demanded. When the U.S. government imposes a new tariff or duty on Indian goods, the U.S. importer has to pay that duty. But those massive U.S. retailers and brands are incredibly price sensitive.
Of course.
So they turn to the Indian manufacturer and say, look, we refuse to pay the higher landed cost. You need to reduce your selling price to us by, say, 50% or 60% of that new duty, or we're just going to shift the order elsewhere.
So the U.S. tariff, which is designed to tax the import, immediately translates into a lower selling price for the Indian exporter. It directly squeezes that EBITDA operating margin.
Precisely. The manufacturer is essentially subsidizing the duty. It's an unavoidable, immediate hit to their operating profit, which is why management is now focusing so intensely on internal cost control just to recover the margins lost to Washington's policy.
And finally, we saw a massive drop in profit before tax, or PBT, down 47% year over year. This has to relate to costs they can control, right? But maybe they're just necessary burdens for now.
Yes, exactly. The PBT decline came from significantly higher finance and depreciation costs, and this relates directly to their aggressive capital expenditure strategy. They are building new factories, new capacity they invested heavily in, but these units are still in the ramp-up phase.
So they haven't yielded returns yet.
Not yet. They are incurring the full depreciation and finance expense of the asset without that corresponding revenue boost.
And that includes the Ind AS accounting impact, correct?
Correct. We also saw the impact of Ind AS treatment for capitalized leased assets. It's an Indian accounting standard that requires assets acquired via lease to be immediately treated as capitalized assets on the balance sheet. So this increases the reported depreciation costs up front, hitting that PBT line hard right now, even if the long-term benefit of the asset is secured. So what you have is a company actively absorbing external tariff costs, while at the same time, it's digesting the short-term financial burdens of its own aggressive internal expansion.
And management knows the external threat isn't going away quickly. They anticipate the U.S. reciprocal tariff on India will significantly impact the entire second half of the financial year.
Which means the pain we saw in Q2 is a sustained headwind. But they also have a policy tailwind they are waiting on, that AGOA reinstatement in Africa.
Which would instantly reverse that 23% revenue drop in Africa, since that region benefits from highly favorable tariff regimes.
Exactly. So their entire near-term strategy revolves around using a financial scalpel. They are intensely focusing on cost optimization and demanding better productivity gains across the group to offset that shared tariff burden and the startup costs of the new units. They have to execute brilliantly to save those margins.
I have to ask about the timing of the CapEx, though. You mentioned they are aggressively investing in new factories, spending 110 crores in the first half of FY26 alone, while their profits are being crushed by the resulting depreciation and financing costs. Isn't that timing a little counterintuitive?
That's a critical question, and I would argue the CapEx is essential. They are prioritizing the long-term strategic positioning over short-term profitability.
I see.
If they wait for market certainty to build capacity, they will miss the window of opportunity provided by this whole China plus one shift. You have to incur the costs now to be ready when the volumes shift permanently.
That structural view also explains their strategic move on vertical integration then.
Exactly. They made a crucial equity investment of 72 crores in BTPL, which is a fabric processing unit. This move strengthens their vertical integration into fabric requirements.
And that means what exactly? Faster delivery.
It means two things. Faster, higher quality delivery to customers, yes, but more importantly, a better control over a major input cost. It's an investment in supply chain resilience and, future margin protection.
And while they spend heavily in the first half across capacity expansions in Madhya Pradesh, Karnataka, and Jharkhand, they are signaling some caution moving forward.
They are. The total planned FY26 CapEx is being moderated slightly, aiming for around 150 crores in total. This shows judicious control over spending given the current uncertain market conditions. They're committed to the expansion, but they're clearly managing cash tightly while they wait for the new units to fully ramp up.
All right, let's zoom out a bit and consider the structural forces that make India, and a company like GOKEX, a long-term investment thesis despite all these immediate headaches. It really comes down to global demand health and sourcing diversification.
The famous China plus one story.
That's the one.
And the global market is healthy enough to sustain this capacity expansion. If you look at the major consuming regions, U.S. apparel imports grew 5% in the first 7 months of 2025. EU imports were up 9%, and the UK saw an 8% increase.
So there's decent underlying demand.
There is, even if U.S. e-commerce sales volumes are experiencing a slight plateau. The real driver, though, as you said, is the movement of supply chains away from China. Geopolitical tensions, rising Chinese labor costs, a need for resilience. It's forcing major retailers to diversify.
And India seems uniquely positioned to benefit over competitors like Vietnam or Bangladesh.
It is. India offers a few specific advantages. A large, highly skilled, but still largely untapped labor force, competitive labor costs, and crucial geographic diversity, which is why you see them expanding into states like Madhya Pradesh and Jharkhand, not just concentrating in traditional hubs.
But the path from all that potential to actual profitability relies heavily on trade policy, specifically free trade agreements or FTAs.
They are essential levers. Look at the recently announced India-UK FTA. That agreement offers a 12% duty advantage over China, and crucially, it puts India on par with Bangladesh for UK access.
And Bangladesh is the gold standard in the region.
They are the gold standard because they already enjoy zero duty access to the EU and UK markets. So by achieving parity, India can now compete head-to-head on cost, which instantly creates massive export potential for that UK market.
And that momentum is expected to carry into the largest economies.
Absolutely. The ongoing trade deal negotiations with the entire EU 27 bloc and the bilateral discussions with the US, they're expected to open up significant future opportunities. If successful, these deals would drastically reduce or even abate the current U.S. reciprocal tariff impact that's holding back their margins right now.
It's a waiting game then.
It's a waiting game dependent on diplomacy. And just to underscore the company's importance here, remember, this is an established, scaled player. We're talking 4+ decades in operation, a workforce of over 53,000 people, 75% of whom are women, and an annual capacity of 87 million pieces. They have the institutional backbone to capitalize when these deals come through.
Okay, so we've established the contradiction in the fundamentals. Now let's transition to the technical outlook for you, the learner, and see how the market has reacted to all this internal strength and external pressure. Looking at the stock chart, we saw a massive, almost parabolic uptrend that ran from early 2021 into mid-2023. That was followed by a long corrective range-bound phase, a sideways correction that lasted until Q3 2024.
And that period of sideways action is the market just consolidating those huge gains, digesting the uncertainty. But the underlying bullish structure remains completely intact. Technical analysis reveals a really critical support level, the 200-week simple moving average, or SMA, sitting around 693 rupees.
Why is the 200-week SMA considered such extraordinarily strong support? What does that specific moving average signify?
Well, it acts as the ultimate long-term mean reversion magnet. When a stock is in a massive uptrend, smart money often looks at the 200-week SMA as the absolute floor. And when the price tested that level in mid-2024, it rebounded sharply and decisively.
So that validated the trend.
That validation confirmed that the long-term bullish cycle structure is still valid. So for you, the listener, the technical long-term support is very firmly established in that 750 to 700 rupee range.
So the foundation is solid. What about the immediate momentum given the recent volatility?
Currently, the price is trading above the 50-week SMA, which is hovering around 891. And furthermore, the Relative Strength Index, the RSI, which is a momentum indicator, is trending upward and holding above 50. It's currently reading about 58.5.
And what does that tell us?
Both of those indicators point toward a clear bullish bias in the medium term. The question is, can they finally break out of that historical consolidation range they've been stuck in for over a year?
And where is that immediate, critical, technical hurdle they have to clear?
The most critical resistance zone is tightly clustered between 940 and 970 rupees. For momentum traders, a decisive weekly close above 970, supported by strong volume, meaning high conviction buying, that would be the definitive technical signal.
Right.
That move would signify that the multi-year sideways correction is finally over and the major long-term uptrend is resuming. If they achieve that, the next immediate target is the psychological mark of 1,000 rupees, followed by the next major resistance level around 1,200.
And this potential breakout aligns almost perfectly with the recovery scenario that analysts have modeled for the company's fundamentals.
It does. Analyst consensus targets for 2026 hover around 1,035 rupees. Forecasts are predicting strong annual revenue growth of 13% to 15%, coupled with really impressive EPS growth earnings per share of 30% to 45% over the next 1 to 3 years.
But there's a big if there.
A huge if. Let me stress again that strong EPS growth is entirely conditional on those current margin pressures abating.
Which means the company needs to successfully execute its internal cost strategy, and they desperately need relief from those external trade dynamics. To wrap up our deep dive today, the Q2 FY26 report for this apparel exporter is a masterclass in contradiction. You have internal strength gaining market share in India, aggressive capacity investment being completely overshadowed by external volatility.
Volatility driven entirely by global trade policy. They are maximizing their controllable factors. Domestic operations, vertical integration for cost protection, intense productivity gains to claw back margin, but they remain critically vulnerable to trade policy shifts.
Particularly the uncertainty around AGA and that inescapable burden of the U.S. reciprocal tariffs.
That's it.
So we have a bullish technical setup, consensus analyst targets near that breakout level, and core Indian business health. But the bottom line is being held hostage by policy decisions far outside their control.
That is the essential insight. And here's the final provocative thought for you to consider. Given that the technical breakout point at 970 is so close to the consensus analyst price target, and the main factor currently preventing margin recovery is that U.S. reciprocal tariff.
The one they're sharing with customers.
The one they're sharing, exactly. So the key variable for continued stock momentum might not actually be how quickly they ramp up their new factories in Harkand. It might instead be the timeline and positive outcome of the rumored U.S.-India trade deal. That political decision has become the most immediate factor to watch for the company's future profitability and its ability to break out.
So keep your eyes on the diplomatic wires as much as the earnings report.
I think you have to.